welcome to today's episode of Esbayeni Connecting the Dots, where we help you understand a lot of different concepts in the investments management space. I'm Nkomo from Inkunzi Wealth Group, the sponsors of this conversation. And today we're talking to Brian Karidza from the GEPF, who actually happens to be the head of Actuarial and Benefits Administration at the GEPF. The most important topic that has happened at the GEPF, I believe, this year is one that we call the Actuarial Interest Factor changes. That happens every 3 years at the GEPF, and we're going to take time to understand the history of this AIF, as I like to call it, and importantly, to understand the role played by the GEPF in the communities and in the benefits of the members of the GEPF, who essentially are people that work for the government in South Africa. Welcome to the show, Brian.
Thank you, Owen. It's a pleasure to be here.
Thank you so much. Can you please guide us in terms of the GEPF? What is the GEPF? Where does it come from? Its history? Where is it now? And how much are you managing on behalf of the government employees?
Okay, that's a mouthful. So the GPF is the Government Employees Pension Fund. We are a pension fund or retirement fund vehicle for all the public sector employees. The GPF was formed in 1996 through the amalgamation of various other predecessor funds. We had the Government Services Pension Fund. We had some of the funds from other homelands, which were all joined together and became the GPF from 1 April 1996. The GPF itself, quite a large fund, as you can imagine. We boast around 1.3 million active members and about 550,000 pensioners and spouses beneficiaries. In terms of the assets under management, we're looking at 2.4 trillion based on the audited 31 March 2024 figures.
That's awesome. That's quite a lot of money. 12 zeros to be exact, Brian, right?
Yeah, exactly.
And the trillion. So 2.4 trillion is what you guys are currently managing.
All for our members.
I thought it was for you. No, that's great. So that's a lot of work, I imagine, for the GEPF. And I think you are not called a head of actuary for nothing. Does this mean that you've qualified as an actuarial scientist or a professional actuarial?
So yes, I am a qualified actuary, although my day-to-day job does not only depend on that.
Yeah.
We provide oversight of the administration function, which is performed by our administrator, the Government Pensions Administration Agency.
Yes,
GEPF. And then we provide oversight on that function to ensure that our members are being serviced and paid as we have contracted with the GEPF.
I imagine GEPF was started at the same time as the GEPF.
Yes. So initially, it was one organization. Then I think following a separation around 2007, which became formal, if I'm not mistaken, around 2009 and 2010,
yes,
they became two separate organizations.
All right. So the GEPF collects premiums or contributions from the members. I'm a teacher, I'm a lawyer, or rather I'm a nurse, policeman, I work for the courts. I contribute on a monthly basis, and then my money goes to the GEPF, and the GEPF does the allocation of investments to the other investment vehicles. And then the role of the GPAA is that the administrative part of collecting that money and putting it together and or distributing it to the members if they resign and so on gets paid out. Is that how it works?
Yes, that's correct. So that's the administration function. They collect contributions from our members on our behalf. They're also responsible for passing on those contributions to the investment managers, mainly the PIC.
Yes.
Although there is a portion that we, as the GPF, do manage internally and allocate to other investment managers. And you're correct in noting that the GEPF also distributes benefits.
Yes.
So we can look at GEPF as servicing us from both ends, the demand and supply side.
Yes. All right. So if I'm a member going on retirement and my money seems to be delayed, is the issues at the GPAA most likely or at the GEPF?
Well, so when it comes to paying members, we take full accountability.
Yes.
Because these are our members. To the member, it doesn't matter where delay has come from.
Yes.
So we take accountability as the fund. My role is to ensure that our administrator pays you on time. So if there's any delay, irrespective of who's responsible, it is a personal responsibility for me, and I will ensure that it's paid.
Okay. So in the space where you work, or the way we work combined, there is two types of pension solutions. You can have a defined contribution, and then you can have a defined benefit scheme. Can you just explain to the members out there that are looking at us what the difference is between those two?
Okay. So it's a common and very difficult question. So because it's two separate type of arrangements which are trying to do the same thing.
Yes.
So let's look at what they're trying to do. Both sets of vehicles are trying to provide you with an income in retirement, but they're set up differently in how they're going to achieve that. Let's start off with the simpler one, being the defined contribution. Under a defined contribution arrangement, each month you're going to contribute to that fund. So the fund is going to take a portion of your salary, it's going to add it to other contributions that have already been taken. They're going to be invested and they'll grow with returns. Then this will keep on accumulating over time. So you can think of it as an accumulating fund, almost like a savings account or a bank account. Then when you reach retirement age, you're then going to use those accumulated savings to purchase a pension, which will be paid to you for the rest of your life. Now, when you get to that point, the terms at which you can purchase that pension are not guaranteed. Now, let's look at a defined benefit fund like the GEPF.
Yeah.
So there are several types of defined benefit funds, but the GEPF specifically is what you refer to as a final salary scheme. What that means is, like a defined contribution, similar to the defined contribution setting, we do collect contributions on a monthly basis from your current salary. But what we're promising to pay you is based on your salary when you reach your retirement age. So we look at your average salary over the last 2 years, and then we pay you a pension based on your salary and your service. So how long you've been part of the GPF up until that point in time. And then we determine a pension, that's your initial pension. And that pension will be paid to you for the rest of your life, and it will continue to your surviving spouse at a reduced rate.
Yes.
Now, when you look at it closely, there are some subtle differences there. Under defined contribution, you sort of have certainty on, and I have to be careful in how I say this because you cannot guarantee the investment returns, but you sort of have certainty whilst you're accumulating your funds.
Yes.
And then where the uncertainty now comes in is when you actually reach retirement. You cannot guarantee the terms in which you'll be able to purchase a pension. And depending with the pension product that you also purchase, you cannot guarantee how long that pension will be paid for. So you're sort of taking on the risk of outliving your savings.
Yes.
You're also taking on investment risk. Now, when it comes to the GPF, the uncertainty comes whilst you're accumulating. There are no guarantees from the fund there. And it is intentional because we are purposed as a retirement savings vehicle. We're trying to ensure that you have a pension in retirement. So all the guarantees that we offer you are in retirement. So if you look at the guarantees that we are offering our members, let's maybe take a step back. What guarantees are there? So the easiest guarantee to understand is a fixed monetary guarantee.
Yeah.
So I tell you that, Owen, I'll pay you 10,000 or I'll pay you X amount.
Yeah.
The fund has that type of guarantee, but only on funeral benefits. Our funeral benefit is defined in a monetary amount. And if a member passes on, or if their spouse or child passes on, they are paid exactly that monetary amount. That's one of the guarantees that we have on offer.
Okay.
The second guarantee is when you reach retirement, the pension that we're going to pay you is not going to be based on the market or market conditions. It's going to be based on your salary and your service. So we've delinked it from the market, unlike a DC where the pension you get is directly linked to
the performance of the market. So you're essentially taking the risk that your numbers are going to work out such that when I go on retirement, what you promised me is what I'm going to receive.
Exactly. Then the other guarantee is we guarantee to pay you for life.
Yes.
As long as you're alive, you're going to receive this pension. There's an additional guarantee where we say if you're going to be paid your full pension. And what I mean by your full pension is if you were to pass on, if you were to unfortunately pass on, pension payments would continue to your spouse, but at a reduced rate.
At a reduced rate. And what is that rate on average?
So the default is 50%.
50% of what my salary was.
Yeah, of what your pension. So remember, we are paying a pension, not necessarily your salary.
Yeah.
So it'll be 50% of your pension. That is the default. So if you were to pass on, the pensions would continue to your surviving spouse, but at that reduced rate. But if you pass on within the 5-year guarantee period, for the remainder of that 5-year period, your surviving spouse would receive your full pension as if you were alive and not the reduced rate.
Yeah.
And they'll only start receiving the reduced rate after the 5-year period. So that is the other guarantee that we offer. Then lastly, And it's not it's not commonly understood by members. The other guarantee is the pension payments that we pay you are not going to reduce. So if you're a principal member and you're receiving a pension, the worst that can happen is you do not get an increase.
Yeah.
So your pensions will either increase
Or stay the same.
level.
Yeah.
But they'll never reduce.
Okay.
They'll only reduce if you pass on, but that's already a beginning of a different benefit payment, which is the spouse's pension.
The spousal benefit.
And then that spouse's benefit, once it starts getting paid, it can only either stay level or increase. And then if you have looked at our history, we've always provided increases. So I can safely say that 99% of the time, your pension will increase.
Inflation linked.
Yeah, inflation linked.
Yeah, that's always a very difficult conversation, because when you talk to members out there, they're like, no, but the basket of food that I am buying seems to cost more than it did last year. And we say, yeah, no, but inflation is up 6%. And they tell you that doesn't feel like it's 6%. It feels like 20, 30%. So then when you give the adjustments on an annual basis, it's very interesting what the members do say. I mean, what was the last amount of the adjustment, by the way, to the benefits?
We grant pension increases effective 1 April each year.
Yeah.
That pension increase is based on your November year-to-year inflation. So November year-to-year inflation was 2.9%, and we granted 100% of that. And maybe to put it into context, because if you look at the absolute number, it looks like a very small increase. But we are currently in a low inflationary environment.
Yes.
And hence why the inflation was low. But to further put it into context, when members contribute to us, they're actually, our law aims for pension increases that are 75% of inflation. So the contribution you pay for us is actually to give you an increase of 75% of inflation. But through us sweating our assets and investing prudently, we're able to grant you more than 75% of inflation, which is why we've been providing pension increases of 100%.
Yeah, to match the inflation growth.
Yeah.
Okay, so the most important thing, I guess, Brian, like I say to the members that are watching us talk today, is the issue of the actuarial interest factors. So if you look at our markets have gone up over the past few years. They're going up. You'll think it's a good thing. And maybe can you just walk us at the things that you consider when you making these adjustments to the actuarial interest factor? Because to put it simply, if you're working out what a member's benefit is at the GEPF, this big pot of money is how long they've worked for the GEPF and what their salary on average was for the past 2 years. Then you multiply that by a factor, which is called, let's call it X factor. But in this scenario, it's the actuarial interest factor. Can you just walk us through what factors are considered when you're adjusting the actuarial interest factor, maybe?
Okay, so to fully understand it and maybe to fully educate our members and do justice to the question,
yes,
let's revisit our benefit promise, because everything we pay comes from that benefit promise. So we are saying that if you become a member of the fund, we're promising that if you reach your normal retirement age, if you reach age 60, we're going to pay you a pension that is payable for the rest of your life. Now let's examine that a bit more closely. We've said that the pension that will be paid to you will be based on your average salary at the point at which you retire. So that's a point in the future. It's going to be based on the years of service you have at that point in time. And it's going to be based on a certain growth rate, which we call an accrual rate, which is defined in our rules. It previously was 1/55, but with all these changes with the two-pot, it's 1/55, and now there are different accrual rates applied for your retirement pot, savings pot, and so on. But I don't want to get into that detail for now. So now we're going to pay you all these pensions. If it was possible to picture a timeline, we're saying that from the future, once you reach your retirement age, you'll be getting a pension payment, a pension payment, a pension payment for the rest of your life. Now we want to know, or at least if I was a member, I'd want to know, okay, what are all, it's not really helping me knowing that I've got all these pension payments in the future. I want to know what they're worth today. Now, how can I show them what those pensions are worth today? And that's where you start getting to the clever guys who go to the actuaries and they say, okay, we've got this problem. We've got all these pension payments in the future that we've promised, but we need to find a way of expressing them today. So how exactly can we go about that? Now, if you think about it closely, there's some challenges. I've said that your pension is based on a salary at a future point in time. I don't know what that salary will be. I only know your salary today. So one of the things we need to think about is how your salary will change from today to the point at which you reach your retirement age.
Yeah.
So there's a certain assumption that needs to be made about salary growth. Once you start receiving a pension, remember I said we give you pension increases. We don't keep it level.
Yeah.
I need to make an assumption about what that pension will be, as that pension increase will be. Because it's, I won't know it with certainty. I definitely have not drank holy water and cannot predict with certainty or prophesy what that pension increase will be. More importantly, once you start receiving this pension, I don't know how long you're going to be alive for. You could live for 20 years beyond that. You could live for 5 years. You could, like, it's something that is an unknown. But we can make educated guesses about the future. Those educated guesses are based on what the markets are telling us. They're also based on what has happened previously, and then it enables us to make estimates about what happens in the future. So when it comes to how your salaries will grow, we look at the markets. The markets give us a measure of what inflation is expected to be in the long term, in the future. And then we say that, okay, in a normal institution, your salary will be expected to grow by a certain margin above inflation. We make that assumption. That helps us to estimate what salary you would have at retirement.
Yeah.
Now, with that salary at retirement, we can calculate a pension that you're going to get. The pension increase you get is going to be linked to that same inflation assumption we've made. Right? We make an assumption about how long you're going to stay alive for, which determines how long we're going to make payments to you and your spouse for. That's another assumption. But
So at the moment, Brian, what is that number? What is that expected
inflation
lifespan? No, the lifespan of the average member?
So for GPF members, it's actually, for the males, they're living up until roughly age 83.
83.
And then females. So remember, we're looking at now the group
Yes.
As a whole.
Yeah.
So 83 and 86 for females. So it's like a 3-year differential between the males and females.
The males live longer than the females?
No, the females live longer.
The females live longer, as always.
Because they're not married to us. And then, what do you call this? There's one thing we didn't discuss.
Yeah.
All these payments are in the future. But we want to get a value today. In most cases, I think you'll agree with me that we live in a world where interest exists.
Yeah.
So I know if you're lending money to me or to your friend, you might not charge interest. You might just give them money and they pay you back the
capital
same amount.
Yeah.
So the GPF does not keep money under a mattress. When we collect your contributions, they are invested.
Yeah.
The board sets a policy, an investment policy, which tells us where to invest. So because we know where we're going to invest in the future, we can make an estimate about the returns we can expect to get in the future. That assumption, or that return that we're expected to get in the future, is what we call the discount rate assumption. That assumption is very important for us because it lets us know, or it gives us an idea of what to set aside today.
Yes.
To meet future payments in the to meet pension payments which are going to be made in the future. So the theory is, if I set aside a certain amount today, that certain amount will be invested, it will grow with interest. And then by the time you reach retirement, that amount would have grown to such an amount that it's enough to pay all the pension payments that we've promised you. So the factors that we look at when deciding on what to put aside today, it's the inflation that is expected in the long term. It's how long you're expected to live. That inflation that we spoke about will drive your pension increases, and it will drive your salary increases. But more importantly, we look at the investment returns that we are projected to get in the future. Those are the things that we look at. And if you look at it closely, and I've tried to make sure that I do not make any guarantees, none of those things can be predicted with certainty. I cannot come here and tell you that for the next 40 years, inflation will be this.
Yeah, and
But
interest is going to be this much. And the people are going to live until 83 guaranteed. They could live until 90.
Yeah, someone could even live up until 100.
Yeah.
I think we have a few pensioners already
100
around
years
that
old.
age.
Yeah.
So all these things cannot be predicted with certainty. Why is that important to understand? It means it can change if economic conditions change.
Yeah.
And hence why we get to a point where we have different assumptions at each valuation date. We have different assumptions being used to calculate actuarial factors.
Okay. So if we were to talk about that, the last calculation for the AIF, or rather maybe speaking about it in general, how long do we take before we do the next valuation?
Okay. So maybe let's expand on that. So the fund, because we want to provide comfort to our members and to stakeholders alike, we are expected to conduct a statutory actuarial valuation. And our law requires us to do an actuarial valuation at least once every 3 years.
Okay.
What this valuation does is it gives you an idea of the financial position of the fund. So it gives you an idea of whether the fund has set aside enough money to pay all the benefits that it has promised to make to members in the future. So that's the purpose of that valuation. But to get to a point where we can estimate whether we have set aside enough, the fund makes assumptions about the future. And it's those same assumptions that I spoke about: the inflation, the salary increases, pension increases, and your discount rates and how long people will live for. So the most recent valuation we've done is the one as of 31 March 2024. Because it's a statutory exercise, it is actually done after the year end date. So we didn't do the 31 March 2024 valuation in March 2024. It was only done after
the event.
And yes,
after the auditing has been done and submitted.
And everything, after we have audited financial statements, after the data has been audited for the membership. So typically what happens is you do evaluation 31 March 2024. The report will only be finalized towards the end of the year, November, December. It's then presented to the board. The board approves that valuation and then is required by law to submit that valuation to the Minister of Finance as the guarantor of the fund. Then we wait for the Minister of Finance to provide his feedback and approval of those results, which usually is you will now be in the next year. So in our case, the approval only came later around April, May 2025. After that approval, we then share those results with the public.
Yeah.
But then it also kickstarts a different process. Because whenever we change assumptions about the future, it means we need to adjust our actuarial factors. But we cannot adjust them blindly without consulting with our stakeholders. So earlier on, I did mention that we've got about 1.3 million active members.
Yeah.
You can imagine it would be very difficult to consult with each and every member. To say from member 1 to member 1.3 million, what's your view, that would be it'll be
cumbersome indeed.
Cumbersome and impractical. So what our law allows us is to conduct the consultation through organizations, being your unions, being your federations, any employee organization. So after the valuation results are made public, we write to each employee organization. We inform them.
How many of these employee organizations have you consulted for the recent valuation?
I'd have to get back to you for the exact number, but I think it would be close to 20. So
20 employee organizations. You're talking about the unions,
unions and federations,
and other formations.
Yes.
Okay.
So we write to them. We inform them of the changes. We inform them of the reasons and the technical aspects or behind the changes, and then we invite them to provide their views, their comments. Some will provide directly. Some will go through a federation or a collection of bodies, and then they'll give a joint view. Others will also appoint their own set of actuaries to review, and then they provide us their feedback. And as you can imagine, whenever there's a decision or whenever the direction is that the factors have to be reduced, there's always a lot of debate and engagement around that, because obviously the unions are trying to fight in the best interests of their members.
Yeah.
But so in this recent round, we had a couple of unions expressing their, not discontent per se, but just expressing the concern in that the factors are reducing. They stated their reasons. We then assured them that this was within the best financial interests of the fund, or this the long-term interests of the fund, and it was on a fair basis in which we are proposing this difference. And we even highlighted that the true factors should even be lower, but we have tried to reach a compromise where even though they're reducing from the previous ones, it's at a higher level than the true position.
Well, what is the range of that reduction at the moment? I know that the average you announced at the end of August, or at the beginning of September, you say that 15% is the average reduction in the factors.
Yes, so it becomes a bit difficult because we've got a wide range of members. We've got our youngest members around 18, and then you got, I'm here speaking about active members,
Active
so those
members
who
only,
are working and contributing. So actuarial factors affect your, the impact of a change in actuarial factors depends on your age.
Yes.
So the younger you are, the longer you have to retirement, and the longer the impact of investment returns. So the younger you are, the higher the impact. So it ranges. I think the highest change was around 33%. This just in the factor itself, not in your benefit entitlement, but just the change in the factor itself. It ranges from 33%
let's just get it right there. So
5%.
the adjustment in the factor does not necessarily mean a direct change in your benefit. Okay.
Yes.
Or it's just the impact on the factor itself.
So for certain benefits, there is a one-to-one relationship.
One-to-one
if you have
impact.
a 10% change in your factor, you have a 10% change in your benefit. But it's not always the case, especially for those who are where we are paying actuarial interest from age 55 and onwards. The change in factors will not necessarily be the same as the change in benefits. It will be lower in most cases.
Yes.
So to answer your specific question, it ranges from 33% to around 5%.
To around 5%.
And then that 5% is for those who are closer to retirement.
Okay, that's quite a wide range. But even if you look at it from that perspective, if I'm going on retirement and there's suddenly an impact, a reduction impact of 5%, let's say it's a one-on-one change and it affects my benefit and it drops by 5%, it's like I've got an additional tax now and I might not have factored that in. And I think that's the essence of the conversation today, to say most of the members that we talk to actually do not realize that this thing happens every 3 years, and that's why we then get to break it down. And this is why we're connecting the dots today to explain to these members what exactly the impacts of the AIF is. And I think we've gone through that. But who is affected by the changes in the AIF? If we could just put it simply, you've got two clusters of members, right? There's members that will stay with the GEPF when they go on retirement. And then there's members that are going to exit maybe and transfer their funds, or people that die, people that, transfer, leave the employment of the government. Are all of those people equally affected?
I've just realized we didn't touch on one aspect.
Yes.
I think it's important that we touch on that first before I answer that direct question on who is affected. So as we were discussing what affects your benefit entitlement, I think I did not explain how then it affects your entitlement.
Yes.
So let's go back to the promise. We said it's your pension in retirement based on a salary at retirement, and it will be paid for the rest of your life, subject to pension increases.
Yes.
Now, we said we need to make an assumption about how your salary will grow from now up until the point you reach retirement. So if your salary increase assumption increases, what does that mean? It means your salary that is projected at retirement will be higher. And if you looked at that in isolation, it would mean a higher benefit entitlement, which would imply a higher factor. Pension increases. If you increase the pension increase assumption, it means the pensions you're expected to get would be higher. And when looked at in isolation, that should mean a higher actuarial interest benefit or a higher actuarial factor.
Yeah.
If you're projected to live for longer, it means you're expected to receive pension payments for a longer period. So when you looked at in isolation, the longer if you increase your life expectancy assumption, it should increase your actuarial factors. So we've looked at those three. And in our case, when you look at the valuation assumptions, you'll note that those three aspects have increased.
Yes.
But somehow we still end up with a lower actuarial factor.
Yeah.
It's because of the last item, which we didn't discuss, or which we haven't yet discussed in detail, which is your investment return assumption, or your discount rate assumption. Now, it becomes a bit counterintuitive when you look at the investment return, because the better the returns you expect, the less you should set aside today.
Absolutely.
So if I banked, let's say if there was a bank and I know that they're going to give me 10% interest, right? And if I knew that I wanted 110 Rand at the end of the year, it means I have to set aside 100 Rand today. Because that 100 Rand would be invested by the bank. And when the bank pays me back, it pays me back that 100 Rand. It pays me back the 10 Rand
The 10 Rand interest.
And then I end up with 110.
Yes.
But then now that would change if the bank came back and said, actually, or if there was another bank which comes and says, but actually I can give you 12%. Right? If I gave that bank 100 Rand, I'd end up with 112.
112, yeah.
But remember, I know what I want. I said I want 110. So if I wanted to limit myself to the 110, it means I have to set aside something lower.
Less, yeah. And so that is where the essence of the actuarial interest factor calculation kicks in. Because as you said when we started, you're essentially guaranteeing members a future pension payment. So you've done the numbers and the assumptions today. But if the assumptions start to say, no, if you put aside 100 Rands today, the market is better, inflation assumptions look like they won't be too much. So you expect a higher number just by virtue of the market growing. So what you put away today has to be reduced. And that is the essence of what actuarial interest factor adjustments going down means, right?
And I want to add on that as well, because the immediate deduction there is, okay, so it just means we can set aside a lower amount, but I'm getting the same 110. Where now it gets a bit confusing and where it gets a bit counterintuitive is it's actually possible to get a higher amount in the future. So it's possible for me to say, okay, maybe I don't want 110, but I wanted 115 or maybe 118. So it's possible to aim for a higher amount in the future, but still set aside lower today. So remember in my initial example, we said I wanted 110, you set aside 100 today.
Yeah.
But that's only possible if I'm getting 10% interest. It's possible to get 112 in the future, which is higher than 110, but still set aside something lower today.
Yes.
But that is only possible if my interest is high enough. So I cannot be getting the same 10%. It would have to be something higher. In my case, maybe something like 12%.
Yeah.
And then I would end up setting aside 99 Rand instead of the 100 Rand before. But I'm now getting more than 110.
Yes.
So that is what happens with the fund, in that if you look at your benefit that you're going to get in retirement, it's actually increasing because that depends on your service. So the more service you have, the more you get in retirement.
The more the benefit you get, yeah.
And then if you look at your benefit statement, you will notice that your retirement benefits will always increase, right? Or at least if you have at least 10 or more years of service. But what those increased pensions translate to today can change. And in our case, it's lower, despite you having a higher benefit entitlement in the future. And the only reason why it's lower is because we have higher expectations of investment returns.
Yeah.
In 2021, we projected long-term returns of around 14.4%, if I recall clearly. Now that has increased to something higher. It's around 15.7%. And because we're expecting higher returns, it means to pay you the benefits we've promised you, we can actually afford to set aside a lower amount.
Okay.
And that's why the factors have reduced.
No, that's perfect. That's perfect. So
now
then maybe just
go back to your
so
question
who's
now
affected?
of who's affected.
Yeah.
So because people clip things, I need to be very careful in how I respond.
Just tell the truth.
Because they'll then say, but he said this, and then I'm affected. So the plain answer is that the change in actuarial factors will affect every active member because the factors are applied to every active member. So when you look at your benefit statement as an active member, we disclose your resignation benefit entitlement. We disclose the balance in your different pots.
Yes.
We disclose what you'd get if you passed on. We disclose what you'd get if you retired due to ill health. We disclose what you get if you retired normally, so if you reach your retirement age. So all these benefits, you're able to see them. Not all of these benefits depend on your actuarial factors. So remember we said when you reach retirement age, what you get paid is based on your service and salary. There's no actuarial factor involved there. But if you live according to a different exit mode, let's say resignations, what you get paid is actuarial interest, which depends on actuarial factors. So any benefit that you are paid that is based on actuarial interest. So anytime we pay you a lump sum
Yeah.
instead of paying you your pension, that benefit will be affected by your change. And that affects everyone. But when does it actually hit your pocket? And I think that's the real question we're trying to get to. If you resign, so all resignations, irrespective of service, all resignations, you get paid actuarial interest from your vested component and your savings component. So the benefit you get paid is directly affected by the change in factors.
By changing the factors.
If you retire with less than 10 years of pensionable service, our rules define that the benefit entitlement is a lump sum equal to your actuarial interest.
Yeah.
So similar to resignation, you would be affected because that actuarial interest depends on actuarial factors. If you're retiring with 10 or more years of service, you are not affected in terms of what gets paid out to you, because that benefit is a gratuity, which is calculated using only your service and salary.
And salary,
And
yes.
a pension, which is calculated only on service and salary. There's no actuarial factor involved there.
All right. So
If
if I'm resigned, yes.
If you're a pensioner and already receiving a pension,
You're not affected.
You're not
Yes.
affected.
Okay. No, that's great. So ultimately, if you're going to leave the scheme with less than 10 years of service, or if you're resigning and doing a transfer, then you are affected.
And for resignations, it's irrespective of service.
Yes.
So whether you have 10 or
30 or 40
years,
you are going to be hammered.
The benefit you're entitled to is based on actuarial factors.
Yes. So is it possible then that at some point these factors could be revised upwards?
Yes.
Has that ever happened, that the factors get reversed?
Yes. So the last time they were revised upwards was actually after the 2018 statutory evaluation.
Yes.
And if we look at the economic conditions at that point in time, it was such that the expected returns and bond yields were actually lower. So if you look at even the returns, let's say if you looked at a 5-year return from your JSE for the period between 2014 and 2019, that is lower than what you'd get from 2019 to 2024. So whenever the economic conditions are such that the expected returns are lower, there is a high chance that actuarial factors will be increased. Now, going back to that counterintuitive problem where, because we're actually in a position where the markets are booming, expected returns are higher, so the returns that we anticipate to make in the future actually higher, it means we set aside lower today.
Yes.
And that means you reduce your factors. So to directly answer your question, yes, it's possible that the factors can increase, but we cannot guarantee today when that will be.
Yes, because we don't know when the markets will go down, and for how long they will go down, and the impact on.
If a different, let's say, World War III breaks out now,
yes,
the outlook of the future will change.
Yes,
or if there's different policies implemented, the outlook of the future will change, and that might necessitate a change in our assumptions, which could then lead to a different outcome for the factors.
All right. So now that we understand the factors that affect your guys' decision making and reducing or increasing these factors, I think the most important question that we have been asked, we were out throughout the country talking about these changes on radio, TV, etc. The one question that has come through is, you announced these changes on the 1st of September. You gave us only 30 days to digest this, and post 30 days, they become effective on the 1st of October, right? That's not enough time that I've been given Mr. Nkomo and Team Inkunzi Wealth Group. I don't have enough time to decide, and I still need to give notice because I've looked at my numbers. If the assumption is that my benefit is going to come down by 15%, for example, which said is like a hidden or a surprise tax to me, means all of a sudden, if my benefit was R1 million, I'm going to walk away with 850,000. I don't like that. I'd rather leave now, but you're not giving me enough time to serve my notice. And I think there was it's actually being deemed to be very unfair. Is there a reason that there was such a limited time for members to consider their scenarios? Because in the past, I think the announcement was made and it had like 2 odd months in the last valuation. I think that was done in 2022.
Yeah, so the last change was effective 1 November 2022.
Yes.
And we did communicate with, I think it was just under 2 months. I think it was 7 weeks from the point of which...
Of adjustment.
Of which there were still complaints. So the answer is there can never be a right time. So anytime factors are revised, especially if they're revised downwards, there'll always be those who are aggrieved. Now, as to why such a short period, it's to limit the chances of you as a member selecting against the fund. So I'm glad you gave that example, because you were saying, so this person was not sure about resignation. It means they're now resigning simply because of factors. And that's what we're trying to guard against. We're saying, if a member is resigning, you should be resigning because you have another job, right? And then we were comfortable with the 30-day period because we're of the view that for those who want to withdraw, I actually forgot to that's the other section of benefits that are affected. Now that we're in the two-pot world and members are able to withdraw from the savings pot, the balance that is available in your savings pot is calculated directly using actuarial factors. So the available balance for you to withdraw from, that is going to be affected by the actuarial factors. So we were of the view that given the short processing time to make withdrawals from your savings pot, if a member wants to withdraw before 30 September, a 30-day period is sufficient for them, because it's a quick decision. They can do it through the app and there's no delays they would experience there. Then for resignations, again, or for other exits, the truth is there can be no right time. So if you look at it, if factors are supposed to be reduced and we've not yet reduced them, it means that the fund is overpaying on exits. And if we extend the time to overpay on these exits, it's a selection against the fund. But the truth is, it's actually a selection against the members who are staying within the fund. So remember that on average, we have close to 70% of our members who are going to stay on from their first job up until they retire within the fund.
So that ratio is 70-30.
Around
exits
yeah, so around
usually 30-odd%. The people that say
o-
no, thank you.
over a 40-year
Yes.
career also.
Yeah.
So the majority of our members stay up until retirement. Now, if you look at it, if you stay up until retirement, you're getting paid exactly what you're entitled to. You're getting paid your fair value. Now you're saying for those who are exiting, what is supposed to be your fair value is according to the actuarial factors at that point in time. Now you're paying them more than the fair value, but it's not coming at a free cost. Whenever you pay more than that fair value, it means someone is subsidizing them. And who is subsidizing them? It's those 70% of members who are going to stay up until retirement. So we have the view that if there's going to be any further subsidization, it shouldn't be from the members. Those members who stay up until retirement, they are contributing the most to the fund.
But in saying that though, Brian, if I plan to leave in November or if I plan to leave in December, all of a sudden I am being impacted by these changes, and I've not been given enough time to make a consideration, saying, wait a minute, if this thing's going to happen and I've only got 30 days, and mind you, there are people that have decided to resign without any knowledge of the AIF, and by resigning, we're talking about guys that are going on retirement in quotation marks, but are going to transfer their benefits to companies like ourselves to manage for them. So that's what we're calling resignation here. You're resigning, you're taking your benefit and you're transferring it out. You wanted to leave in December, but all of a sudden you've got this 15% element. I think that maybe going forward, because it does seem like the fund ambushed those members. So maybe going forward, is it a possibility that a bit more time could be given, maybe even up to 3 months for considerations? Because the fact that we're doing this conversation today means it's going to go out. People will learn how the AIF works. Already they know that the next round of adjustment is going to be done in 2027, 28. So if that's the case, then I'm sitting here thinking, if in the beginning of the year in 2027 or 2028, I think 2028 is the impact, is the adjustment year, right?
If we were to do...
If you were to use a similar...
similar.
So if I'm going to leave in 2028, then it suits me best to leave in the earlier part of 2028. But because people will understand and learn more about the AIF adjustment, they are not going to wait for you guys to give them 30 days in 2028. They could actually make their decisions to transfer and exit earlier than that so that they're not impacted, you see? So what we're trying to avoid by giving people these 30 days might actually, because of virtue of us educating the members, and we're grateful that you joined us today.
Well,
It might be something that stays with them that says, yo, I don't want to be affected next time. It's in Hambe earlier, you know?
So I hold a totally different view.
Okay.
And maybe let me try to explain my position.
Yes.
So we said we exist to pay pensions for members.
Yes.
So we are a retirement savings vehicle.
Mm-hmm.
And we said, as part of a DB arrangement, we are going to give you guarantees in retirement. And our view is that in retirement is when you need the most guarantees.
Mm-hmm.
So now, if a member is deciding to leave the GPF before retirement, specifically in this example where they're saying, okay, we want to transfer our benefits to another fund, what does that mean? That means you are now willing to take on the risk. Remember, the GPF were acting as your shield. We're saying, stay with us up until retirement. We'll protect you against market movements. We'll give you a defined benefit. Now, if you willingly say no to that guarantee, because that's what it means if you decide to resign and not retire, it means you're willing to take on the risk of the market movements.
Yes.
So if you're willing to take on the risk of the market movements, then that's exactly what you should do. So the fund cannot delay implementing decisions that are in the best interest for the majority, for those who want to take on a risk. So by virtue of resigning, you're saying you want to take on the risk.
Yes.
So that's why we're saying that. So remember, we're not shortchanging you. We're saying we want to pay you your fair benefit. The fair benefit is what is based on those actuarial factors. It just so happened that due to the processes we have to follow, we could not make the adjustment earlier, because the adjustment was actually supposed to happen 31 March 2024. But there's been almost more than a year from when we were supposed to adjust, and we were adjusting them later. And then the other aspect of it is the reason why the factors have changed is because economic conditions have changed. Had you stayed with us, we're saying that you trust us as a fund to invest whatever benefit entitlement you have, and that will generate the returns that we've made assumptions about, and that it will grow to be enough to pay you all the pensions we've promised.
Yes.
Now you resign. You're actually saying that I trust someone else to generate those returns and more.
Which there's nothing wrong with that.
Yeah,
if you can trust someone else that you have done your research and they're going to benefit you, I think it should be your right to do that, right? And again, I think you spoke earlier, Brian, about that 5-year guarantee period, which I think has also been one of the biggest problems for most of the members at the GPF, where you say, if I stay with the GPF by choice, I retire and my fund stays with the GPF. If I live for 5 years, there's not going to be any lump sum that goes to my family post the calculation of the 5-year successive annual benefits that I could get if I die in the 5-year season, 5-year period. So post that, there's no lump sum that comes to me. Let's say, for example, if I resign today and I've got 4.5 million, that is in my benefit statement as my resignation benefit. So I at least take that money, I invested with Inkunzi Wealth Group. But if that same 4.5 million goes to the GPF, my calculation of the gratuity, whatever the amount is, sometimes it's 25%, sometimes a little bit more. Maybe you can elucidate on that as we continue. So if I choose to stay with the GPF, firstly, I'll get a gratuity. And then over the next 5 years, post my retirement, I'll get a calculation that the GPF itself works out. And it reduces until it gets to zero on the 6th year, right? But like you said, members are living up to 80. Let's just say they're living up to 70. But most of them on average, according to our experience, at least they live at 55 up to 60. So you've got 15 years more that you can live, right? And what we've successfully done is to make these investments that have get good returns, on average 10+% returns that we have enjoyed because of diversified our investments on behalf of the clients that join us. So the challenge becomes, my husband worked for the GPF, or rather for the government, and stayed with the GPF. Then he dies at year 6. I'm the spouse, I'll get 50% of his salary, but there's no lump sum that comes out of that. But if he had left with me, because I left and I transferred my money into a private fund, even if I die 10 years down the line, whatever is left in the pension fund that I invested in, and I'm getting my living annuity from, that goes to my beneficiary or my children. So now if I wanted to take a risk in the same manner that you've put it, say, leave the GPF and take the risk that someone else is going to look after you better than us. If I want to do this, then whatever happens with the investment growth, the bottom line is I can then transfer the benefit to my children, to my beneficiaries, post for the 5-year guarantee period. But in this scenario, because I understand the semantics and the calculations of the IF and how it changes, it essentially looks like I'm getting penalized for transferring and exercising my right to transfer my pension to my children if I live post 5 years, you see. So I think that this big sense that we've received from the members of government departments that we speak to is that that right still needs to be given a chance to exist. The right for me to transfer out and take my risk without being penalized. As much as I understand sitting next to you and having spoken to you, that there's a reason for the calculation and the change in the AIF because it makes sure that the assets and the liabilities are balanced. But when it comes to me, I'm planning to transfer, but now I'm affected. So I'm kind of being forced to say, if I don't want to be affected, then I must stay with the GPF in a way, you see. So I think that's one of the conundrums we have faced in the discussion with the members, right? So ultimately, as an example, someone had 5 million rands in 2022 and they wanted to live with us. And then these factors changed. You lost about maybe 15 odd percent. Let's call it 15%. And then ultimately decided, yo, this is a lot of money for Nkomo. I'm going to stay on with the GPF, you see. So the right for him to then transfer is still alive now. He's healthy, he's athletic, he runs, he jogs. The chances that you live longer are quite large, unless he gets hit by a bus or something. But now the challenge is he's not going to be able to transfer that benefit to his children, to his wife, if he dies post the 5-year guarantee period, you see. So that's a conundrum that I feel that needs to be addressed because exiting members feel that their right to transfer is being taken away by virtue of this lower number. If it's big enough, for example, for someone who's worked for 25 years and relative to someone who's worked for 40 years, obviously the one with the lower service is going to be affected more because they still got a long time to retirement, right? Depending on the department. So therefore, do you not sense that maybe you need to give people enough time to consider their scenarios at every actual evaluation? Because we know it's going to happen in 3 years. There's enough time to plan. Give me 3 months at least before you implement the changes.
Then, okay, so I hold totally different view.
Yeah.
But maybe let me start with the 3 months plan. The person who come after 3 months will have the same complaint. So that's why I said there can never be a right time to change factors.
Yeah.
Because it affects everyone. The next person will be affected. And in the same way in which right now, someone can say, but someone who left in 2014, they had higher factors. Like it all goes back to the moment you leave the fund, it's like a divorce. You're saying,
it's a hostile divorce.
Not necessarily hostile, but you're saying, I can do this by myself. I do not want to benefit from your guarantee. And then we say, okay, we agree you don't want to benefit from our guarantee. So it means you have to be subject to the market. Now, let's go back to your example. Yes, someone very close to retirement. Okay, they would have received the 5 million had the factors not changed, and now it's 4.5.
Yeah.
Right. We're only looking at one side where we're saying if he dies within the 5 years. So there's also another side. What if he lives longer than what we've set aside for them? We as the fund are taking that risk. So now it becomes a personal decision. But what we are saying is, if you want to make a personal decision to take the risk, then you have more than every right to do that. But as a fund, we are here to protect the members who are going to retire
choose to stay with us.
Yes, because they are the ones who are going to contribute the most. They are the ones who are going to benefit from our guarantees. Everyone else, unless you are forced, and I would like to believe you do not force members, unless you're forced, you're willingly making the decision,
the choice,
to forego the guarantees from the fund and to go with another party to provide you with benefits. And it could work out. Maybe you, like you say, you get that amount and you pass on quickly, and then your beneficiaries get that. But then the challenge is, again, we cannot predict that with certainty. So it has to be a personal choice, but it has to be a personal choice understanding the risks. And what I always advise members is, when a benefit is designed, it's designed for the average person. We do not have a benefit that can meet the needs of every individual, because everyone has different need. There's someone who has got a big family who are young and benefits from our guarantees.
Yes.
There's someone who might be alone and very sickly, who might feel as if our guarantee is not worth it. So when making such decisions, you have to look at the risks you're willing to take and make sure that you understand them. And then as a member of public service, also understand other benefits, which are not GPF benefits, that you might be foregoing.
Yeah.
Make sure that when you look at your position after, that it gives you a broadly similar position or better position than you would have been
if you had been
in the GPF.
With the GPF,
The worst thing that can happen is you decide to take on the risk, you lose this post-retirement medical aid benefits and so on, and then you benefit from being in a different arrangement, and then you live longer than you expect, and then you start comparing yourself to someone who stayed in the GPF who might be getting a better guarantee.
Yes. So look, I guess
So it's all about, I think what I would always advise is everyone is an individual, understand the risks that you're taking on. We are of the view that if you've worked for a long career and stayed with the GPF, why live at the point when we're about to give you your biggest guarantee? We believe that your guarantees are worth more in retirement. I worked out the math recently. If you stay with the GPF for 43 years, and if you willingly transfer your gratuity into the pension, like the top, if you top up your pension from the gratuity that we give you, if you top it up and make it all a pension, you will retire with 100% replacement ratio. I think that is a good benefit design.
Right, just to help our viewers, the replacement ratio is essentially saying that I'm earning 10,000 rands now,
And
so
then my
post-employment, I want to still earn 10,000
10,000
rands.
as a
So in
pension.
the scenario you're talking about is 10,000 before and after retirement. So I think that makes sense what you're explaining. But as a member of the scheme, if I want to actually transfer my benefits to my beneficiaries, if, like you have said, it does appear that people are living longer now, medical advancements, living healthy, eating broccoli and everything else is making people live longer.
Don't forget the exercise.
Exercising as well, yes. So it means people are living longer. So I am likely going to outlive the 5-year guarantee period. So if I work for 40 years, it does make sense then, or at least some people might consider it sensible to say, if I do a transfer, that's the only way I'll be able to pass on my wealth to the next generation. And as you know, most people, actually Africans mostly, you never get to see $1 million in your account unless if you have a pension payouts that comes through to you. So that's how we create wealth, through my father passing on his pension, and I invest it better. And then I also do the same for my son, you see. But if I say, no, I'm opting to take option A, which says I'm staying with the GPF, but God keeps me for longer, I can't transfer money to my children. And we've had lots of inquiries from members who've said, my father died, he was a teacher. When he died, we didn't get any lump sum, but he was working at the GPF. Yes, he was getting paid every month, because we understand that if you stay with the GPF, you will get paid until you die, right? But then the members still need to get educated to say that no, but because they opted to stay with the GPF, the lump sum scenario ended at the 5th year of his post-retirement life, you know?
Because that was the end of the guarantee there.
That's the end of the guarantee. So that's actually the downside, which for businesses like us is a blessing, because I don't think you guys are ever going to change that 5-year guarantee, which means
it's up to the board.
Yeah,
I can't
it is.
say
Yeah,
on
it'll take
record that it will not change.
it'll take quite a lot to change that. So I think that in conclusion, my perspective is that if you can find someone who has got a good enough opportunity or good enough investment understanding, and they can help you make your investments return inflation plus 3-4 odd returns consistently over the long term, you can actually be brave enough to take that risk to exit the GPF. And we have successfully managed to do that over the past 13 years that we've been around. Our returns are fairly decent. You know, I don't want to talk about the GPF's returns at the moment. maybe we have another conversation around that. So you tell us how the asset split looks like, because we just wanted to focus on the AIF. But I think that it's important to get advice for people viewing this conversation. It's important to get advice, and we are there to give you that advice as Inkunzi Wealth Group. And we like to do it independently. That's why we're brave enough to say, let's partner with the GEPF and break down and educate you about what the actuarial interest factor is, and a few other things as well. You guys are managing 2.4 trillion. That's a lot of money. And actually, there's a big responsibility you carry to guarantee, the 1.3 active members and the 500 or 1,000 retired members. That's a very brave thing to do. And I think that we commend you guys for that. And importantly, we want to say thank you for the support you guys have given people like us who had questions, on behalf of our members. And I think it's quite interesting to understand how the AIF changes. And then maybe throwing it forward, Brian, we're not sure when in 2028 the revisions are going to happen. But I'd like people watching to understand that every 3-year cycle carries a reevaluation of the AIF, and we cannot predict how that will go. But I'm hoping that from this conversation, they've benefited from how we're positioning and trying to educate them about why the AIF changes. And the timing is always very important. If you're planning to go on resignation, and if you're staying with the GEPF, if that's your choice, you're not going to be affected. But I'm not sure if you've got any parting shots for the people watching us, Brian.
So I always like to part with this message. The GPF is an excellent retirement funding vehicle. We provide you the guarantees when you need them the most, which is in retirement. If you treat us as a pre-retirement vehicle, you will not be subject to the guarantees and protection that we offer you. And hence why sometimes you view it as if it's not a good enough vehicle. So we always urge our members to understand that we are a post-retirement funding vehicle. We exist to pay you your pensions in retirement, and that is where we give you the guarantees. We are not able to give you guarantees before retirement because we need to make assumptions about the future, and this future is uncertain. And that's why assumptions can change, and that's why we have changes in factors. But it also does not only mean that factors can only go downwards. If economic conditions are different, factors can be revised upwards. But I just wanted to give that clarity.
Okay. All right. No, that's great. Just one last question, Brian, that we forgot to walk through. So let's say my resignation date is the 30th of September. And according to the new changes that you've announced, the new actuarial factors kick in on the 1st of October. If my resignation is on the 30th of September, and I've submitted my documents, and on the 1st of October, I'm sitting at home because my last day was the 30th of September. What are the chances that, because the process can take 2 to 3 months for the finalization of my benefit to be transferred out, if I've opted for the option to transfer out or withdraw, if we may call it that, what are the chances that at calculation stage, my benefits are going to be affected by the new changes? And addition to that, I believe based on the Q&A you put on the website, you had answered that question already and said anyone who's leaving before the 1st of October is safe. Even if the administrative process takes longer, you are safe. What is my remedy then if at the stage of calculating my final benefit, 2 months, 3 months into the process, even if my last date was the 30th of September, what do I do if I realize that my number was reduced based on the factors? What should I do?
Okay. And thank you for that reminder. I think I was supposed to leave with that, and that you can get more information from our website, and we've outlined a detailed FAQ document which tries to explain actuarial factors and the questions around them. So now going back to how you'll be affected in terms of your exit date. So if your exit date, and by exit date is the date at which you stop being a GPF member and contributing to the fund, if that exit date is before 30 September, then your benefits will be calculated using the old factors, the factors
The old
that
factors.
are there. So if you resigned in September and your employer agreed that your last date was 30 September, your last date of work was 30 September, which would mean that in October, GPF does not receive a contribution. You're no longer a GPF member. Your benefit, irrespective of when it will be paid, will be calculated based on the 2021 factors.
Yes.
So we've got a 60-day turnaround time. So perhaps you get paid in November. The benefit you get paid is based on the 2021 factors. Now, where we need to be careful, because some people have longer notice periods. You might have resigned in September, but if your employer says you are going to serve 2 months notice and only exit in October,
then that becomes a problem.
That means you are exiting in October after the factors have changed.
Yes.
That means on 1 October, we are receiving a contribution from your employer on your behalf, meaning you're still a member on 1 October. So in such a scenario, whenever you have an exit date after 30 September, you will be affected by the changes.
Okay.
Similarly, if you go today and you say, you know what, I want to withdraw from my savings pot. If you withdraw before 30 September, what you can access is based on the old factors.
The 2021 factors.
Yeah, so you could go on the 30th, make a withdrawal, and only be paid in October. But that withdrawal will be based on your
historic numbers,
on the 2021 factors.
Yes.
But if you now come 1 October or after 1 October and say, I want to withdraw, the new factors will already be effective. So it's like going to the garage when they've changed, when they said on Wednesday,
when the fuel prices changed after 12 midnight.
If you go on the Tuesday before 23:59 and they fill up, they should charge you the old price. But if you come the Wednesday morning, you're now paying the new price. So we operate in a similar manner. If your exit date is recorded as 30 September, irrespective of when we pay you, your benefit will be calculated based on the old factors.
All right, so just
if
make
ever there is an error that you identify,
Yeah.
and if it is indeed an error, then you will write to the GPF and we'll make the correction.
Okay.
But only if it is an error.
Yes.
Like I said, I want to caution members because there might be those who have resigned in September but only exited
in
October because they have to serve like 2 months notice
yes.
period.
Yeah. So in this scenario, you have to have served your notice. And if you're an educator, you are not standing in front of the class on the 1st of October.
Yes.
And there's no contribution made for you in that particular month, then you are safe. However, if there's a scenario that says you're not standing in front of the class on the 30th of September, you have the right to submit an email or a request for a revision of the calculation at the calculation stages.
Yes, because
who do I send that to, Brian? Do they send it to your department?
It should be directly to my department or inquiries at gpf.co.za. But they're also welcome to go to through the employer to say that, okay, there seems to be a mistake here. Can I review my form to see what exit date you have used?
Okay. No, that's perfect. No, thank you so much. You've been watching an amazing episode of Connecting the Dots, where we're talking to the GEPF's Brian Karidza, who's from the Actuarial and Benefits Administration team at the GEPF. And the important thing is, in isiZulu, we say, "Selidumele dlula." If you are only going to leave post-October, you're going to be affected by these factors. But if your last date is before that, then at least you have a chance to actually still engage your employer or the GEPF through GPAA via email. Just highlight to them that I did not go to work post the 30th of September, so I need my calculations to be redone based on the old numbers. But again, we're always thinking about the future. 3 years is around the corner, or let's call it 2.5 years is around the corner. Get advice, think about things, because the same thing is going to happen. Maybe not the same thing in terms of quantum or in terms of the direction of the move of the factors, but you need to seek advice. We are there to assist you, Inkunzi Wealth Group. You'll find us on the internet, inkunziwealth.co.za. But more importantly, just do your research and understand what the AIF impact is. And we're more than happy to assist where there's any questions on top of this. Thank you so much. Ayikho Inkunzi Yobuthongo.